Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, New York coffee. The market had since late January been pressing down, making lows last week not seen since, November 2024. In the big picture, I originally put this down to the September to October 2025 bearish shift pitch hook in showing the way lower, but it was helped by the late December last year to January this year, very lopsided, not very big, but very lopsided head and shoulders top. The subsequent move lower punched down to the 50% Fibonacci line of the January 23 to February 25 move at 286.10. However, this halt was only temporary, and prices pushed lower 2 weeks ago, down to the July lows based around the June 2011 high at 276 3/4, where we had started a small stabilization. The pattern these actions left us with was a descending scallop pattern, formed over early February. By mid-February, prices broke down through the ski jump part of it and gave us a primary target X in the 263 even zone, and a secondary much harder to reach target X1 down in the 219.5 zone. I also drew last week a small but seemingly effective so far bright red January based bearish Andrews pitch hook, as the market has utilized the bright red lower time, which is currently 262.45, and today punched up over the bright red middle time, which is currently 281.05. I'm hoping this will continue to show the bearish angle of attack. There is something else I'd once again like to look at here, and for this I'm indebted to Ray Bradbury for asking me about New York coffee 45 weeks ago. And I went at the time to my longer term charts, the monthly charts, where you can see some possible insights. You see on the monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025. It is a multi-year 2012 to 2024 very large reverse head and shoulders bottom, with a bright red neckline on my chart currently at 278.10. Remember that level. The break higher over this neckline reached its primary target on the upside and just about reached its harder to achieve secondary target. Then the market turned lower, significantly lower, but the fall held in July and again in August last year, with the market forming a small base right on top of the bright red neckline. It was a horn bottom, if you will. Then in August 2025, with its monthly key reversal up, the market raced all the way back upwards, with an extension higher in early September 2025, but not reaching quite as high as we saw back in February last year, before dropping once again, moving lower, and finally last month reaching the bright red neckline once again. In all these actions, the market has formed what looks like the mother of all long-term double top patterns between late 24 to date. So where now? Well, consecutive closes below this bright red neckline, assuming no false breaks of course, and we'll have such a double top pattern with all the implications such a move lower might have. Please just remember, these patterns here on this monthly chart are longer term, in some cases very long term patterns, and I cover them more fully in my longer term coffee technical analysis video commentary published in January. In the meantime, please just keep that bright red, slightly breached but not yet broken neckline, currently 278.10. Please keep it in mind. London coffee. Now, 39 weeks ago, I said of the bearish pressure on this market, and I quote, "They now have the overhang of the market from roughly 5,300 up to this year's high at 58.49 sitting above." End of quote. This overhang of bearish pressure and ammunition is important, as it started back then to press down, heightening the breaks lower. The main overhead resistance since then, the February 25 to date downtrend, currently at 41.56, had enough of an impact on me that I drew a parallel bright red bear channel based around the September and December 2025 lows, with a bright red lower bear channel line currently at 33.69. Back in September last year, we had some previously significant resistances that turned into supports, and some very keen ones, notably the trio of interesting 50% Fibonacci lines. The first was the November 21 to February 25 move at 38.08. The second, the May 21 to February 25 move at 36.49, which held up the market in late December last year. And crucially, the third, the March 20 to February 25 move at 34.81. First two eventually gave way, becoming for a while resistances, and the 50% Fibonacci line at 36.49 is once again support. The third, down at 34.81, has been threatened with testing throughout most of February, though it looks like this has now passed, and instead the 50% Fibonacci line at 38.08 may now be tested instead. However, for all these earlier moves lower, what now? Well, I said 2 weeks ago, and I quote, "We might take a leaf from New York Coffee's book and look at the last 3 weeks' actions as a possible descending small scallop pattern." End of quote. This seemed a likely case, and I went as far last week as laying out a primary target X down in the 34.15 zone, and a secondary, much harder to reach target X1 down in the 30.04 zone. I added at the time, and I quote, "We'll now see over the coming weeks if this vicarious analysis from New York Coffee works here." End of quote. Today I'm not so sure, though I'll reserve my judgment till I see how the market reacts to the 50% Fibonacci line at 38.08 and a declining green short medium moving average, currently 38.52. Finally, I've done something I was thinking about last week, and I spoke about it as well, and that is to draw an October 2025 to late January 26 bearish Andrews pitch walk. And for this, I'll also be watching how the market reacts with the nearby upper time overhead, which is currently at 38.73. Now, I have no qualms about morphing this bearish Andrews pitch walk to a shallower bearish shift pitch walk for the same move if the action requires it. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.